Something unusual is going on in the stock market, and it's that European shares and Asian shares are doing better than American ones. So if you look here, you can see how they've performed since the start of the year. American share prices have fallen outright, whereas those in Germany, in Hong Kong, in Europe more broadly, have risen. What's happening is that investors are increasingly deciding that Donald Trump's trade policies, especially the chaos of, announcing tariffs one minute, rescinding them the next, that's going to do more damage to American firms than to those elsewhere. But there are some other big shifts going on in stock markets at the same time. One is that investors are going from betting on red-hot economic growth to increasing chances of a slowdown. Now, you can see this by how they're pricing value firms versus growth firms. So you can see that value firms have held up a lot better than growth firms have. Now, value stocks are stocks that are cheap relative to their underlying earnings. What that means is that in bad times, they tend to do better because they're cheap already, they have less room to fall. Growth stocks offer better future returns, but are expensive relative to their underlying earnings. That means they have more room to fall during bad times. So when you see value stocks doing better than growth stocks, that's evidence that investors are shifting from optimism to pessimism. Now, usually when that sort of shift is going on, you would expect certain assets to do very well. An example is gold. That's something investors tend to buy when they're feeling nervous. And in fact, the gold price has done really well recently. It's broken new all-time highs. But there are other normal favourites when investors are nervous that have not done so well. One is American Treasury bonds. The prices of those have actually fallen over the past couple of weeks. Another is the dollar itself. That tends to strengthen when investors feel jittery. Instead, it's weakened. So what we're seeing is correlations that usually hold instead breaking down. Now, the third shift might not seem so obvious, but it's just as important. It's that Japanese yen borrowing costs have risen. Now, you can see here that for most of a decade, they were near zero or below it. And over the past few years, they've shot up quite fast. Now, when those borrowing costs were near zero, that was very useful to traders because they could borrow cheaply in the yen and use it to fund positions that would offer high returns. So, for example, you could borrow cheaply in the yen, use it to buy stocks, get good returns. That trade becomes less attractive when yen borrowing costs go up. And in fact, last summer, as they rose sharply, lots of traders exited positions like this all at once, and that caused a fair bit of stock market turbulence. That then stabilised, but borrowing costs have continued to shoot up. And if that carries on, you'd expect perhaps more positions to be unwound, maybe a bit more stock market turbulence. Now, the past few weeks' price action, it's just a few weeks' price action. You wouldn't want to make any big decisions based just on that. But if you see these tectonic shifts beneath markets continue, that really is something to keep an eye on.